Good morning. I think we should probably call our panel up here unless everyone wants to look at the backs of our panel members. So why don't we just do this in one fell swoop, guys? Come on up. And I'll spend a few minutes here before we introduce our panel members. This panel was entitled Meet the VCs, but I've changed it on the fly to Meet the VCs and the CEOs because we've got a mix of both on here, which I think is great this morning. And it's great that all of you have come out to join us this morning on this absolutely beautiful day in Atlanta. And to you and all my former IBMers, thank you for, again, offering the use of this facility. It's fantastic, and IBM is a great partner with us here in Atlanta. You know, I was a member of the first business launch competition as a judge with Gary Betty and a host of other folks here in Atlanta down at Georgia Public TV, and I was talking to Tino this morning at how far this has progressed in those days. And I also, as an entrepreneur and as now a venture investor, feel like this is a very, very important part of our community. And I also wanted to thank GRA and TAG for teaming up to make this possible. You know, clearly $300,000 plus $100,000 in cash and $220,000, as Tino said, in services doesn't take you the full distance, but it's a heck of a way to get off the ground. And I think what you'll hear today, $300,000 is a lot of money anytime. I think those of you that know the ISS story know that we had about $172,000 worth of credit card debt that we built the company that we ultimately sold to IBM for almost $1.6 billion. So $300,000 can go a long way. And I think with the exception of talent, the single most important aspect of building a business is access to capital. And in many ways, the venture capital community today reflects the current state of the economy and the current state of Wall Street. According to VentureSource, M&A and IPO deals around venture-funded companies is projected to be down about 60% from last year and is likely to reach the lowest point in decades. So today, what we want to explore is the recent trends in the venture capital industry. And, you know, we're fortunate to have some of the leading minds in venture and some great entrepreneurs on this panel to do that. So let me begin. I'm going to make an introduction of each of these gentlemen. You'll see from my introduction that it is very brief so we can get into the panel discussion and keep this in line. I'll start with Mark Berry. Mark is a venture partner with OpenView Venture Partners, which funds expansion stage companies. Was founded in 2006 with a focus on high growth software, internet, and technology enabled companies. Mark's got over 25 years in the IT business. And Mark, we're happy to have you this morning. Thank you for joining us. Matthew Shagan at Trident Capital. Matt is a vice president at Trident Capital. Trident Capital is a well-known venture firm with over $1.6 billion of capital under management, and it's focused on world-class information services and software businesses. Nelson Chu, who many of you know locally here in Atlanta at Kinetic Ventures. Kinetic, a leading investor in comm, information, and power and clean tech driven businesses. And Nelson, I think, has been there since the same year we took ISS public in 1998. So all of these guys are seasoned venture investors. Kevin Costello from Ariba. Good morning, Kevin, and welcome. Kevin's president of Ariba, and I think all of you know who Ariba is. Not only are they a growing and important company in the fabric of our IT infrastructure and business processes, but is also a company that went public about the same time we did at ISS. Kevin is president of Ariba and operates their sales marketing channel and worldwide business development and services delivery. So he's got a very large responsibility there. Tom Crotty, who was one of the general partners at Battery, joined the firm in '89. So Tom's been out there over 20 years at Battery, focusing on investment in technology companies. Tom was one of my judges in the first business launch competition, so I know he's no novice to this event, and he has been involved with so many Atlanta companies and national companies, but probably two that everyone would know: Cipher Trust and Witness. And so, in addition to a host of others, Tom is also a active board member on the GRA, and we do appreciate your participation there. Matt McConnell, everybody knows Matt here in town, good Georgia Tech man, president and CEO of Knowledgent. Matt co-founded Knowledgent in '95 and has continued to run and build that company. Is also the author of a book called Customer Service at a Crossroads, and Mark and his company hold over 11 software patents. So he has been out there on the fundraising side of the business for quite some time. And then Roger Hurwitz. Roger, good morning and welcome. A partner with Fidelity Ventures, which provides expertise, resources, and connections for entrepreneurs that need to take their business further. Roger's mainly focused on growth equity investments in software and technology. So, gentlemen, thank you all for joining us. We are structuring this panel in the following way. We've got a handful of questions that we think will be extremely relevant to both you as an entrepreneur, a professional, a service provider, or a member of the Georgia technology community. We've pre-selected a handful of questions that I'm going to ask the panel. We're going to open up a dialogue about these questions, and then most importantly, we're going to have an opportunity at the end of this program to take some questions from the audience. So, again, thank you for joining us this morning. Let's jump right into the questions. So, the recent financial crisis, or credit or liquidity crisis, or however you want to frame it, coupled with a looming recession — we are clearly in recession — has seized up credit markets. Well, as we all know, very few high technology companies are typically funding themselves with debt type credit or any other type source of capital. Typically it comes from venture and angel investors. But our first question this morning is, how has this affected venture capital funding? We know how it's affected bank lending and mortgage lending and other things. So I'd like to start the panel this morning with a simple question, which is, how is this affecting venture capital funding from our panel of experts? And I haven't picked anyone, so anyone who has an opinion on that, why don't we start? Got it? All right.
So actually, it just so happens that Trident Capital is out in the market raising its 7th fund right now. So we've got an interesting perspective on what's going on. We're on the same side of the table as a lot of the entrepreneurs as far as raising new capital. Just to give you perspective, for our fund 6, which is our current fund, it took us about 4 weeks to raise that fund. We had twice the commitment we were looking for. We raised a $420 million fund. It had about $800 million in demand. Excuse me. This time around, we went out again for about a $400 million fund, $350 to $400 million. We kicked off the process in February. We're optimistic that we'll have a first close in July. But the fact of the matter is, out of our limited partners, who are the people that give us the money, they are significantly impacted by the credit crisis. They are way over their allocations for venture capital and private equity. And as a result, it's an extremely tough slog for even somebody like Trident that's got a great track record and good performance. Excuse me, over the next several years, what I think you'll see is that the venture capital community is going to constrict by probably 10 to 20%. A lot of the funds that have just started up recently, a lot of the funds that haven't had solid performance are going to be out of the market. And so I think what's essentially going to happen is that the venture capital market is going to be more constrained and more selective. I'll leave it for a broader question of whether that's actually, in the long run, a good thing and you end up having a more healthy venture capital community coming out of it. But I think things are going to get more difficult before they get better as far as venture funding goes.
Thank you, Matt. It's a good summary. Anyone else seeing anything different? Is it easier to raise capital from your limiteds? Any phone calls from limiteds requesting liquidity?
So I would echo that. As you may know, I mean, a lot of us have actually just doing our annual LP meetings. And so it's a good opportunity to kind of hear from them what it looks like in the market. And I think in general, when you've got even Kleiner, out looking to raise revenue or raise cash, it kind of tells you how tight the market is. And I would say that definitely it'll constrict, which is a good opportunity for us that have recently closed funds. So we've got some fresh capital, but I think it's tough out there for sure. And I hear it from a number of companies as well that are trying to raise money, but some of their existing investors are either tapped out or they're just they're kind of exhausted. So we're here.
Thank you, Tom.
Yeah, let me add one further thought. Flipping it from the fundraising side to the putting the money outside. Mm-hmm. The venture market is just like the credit market. It's just like the stock market. It's going to go through cycles of risk aversion and risk tolerance. And we're in a cycle just like everybody else of risk aversion right now. And you saw it in the first quarter numbers. The amount of capital that was deployed by the VC industry was down, was it 60% or something? It was pretty substantial. Mm-hmm. But it's a cycle, and it'll come back. And yeah, the way I look at it, I can already see it in my own business that Q1 was pretty slow. I think we did 2 deals. We're going to do 5, I think, in Q2. And the pipeline, the number of deals we're looking at in the pipeline is growing. So I think you'll see by the end of the year we'll be kind of out of this mindset and kind of back in business. And I think, for those of you who are out raising money, it's going to be real tough. It's been tough. It'll probably be tough for another quarter or two. But as we turn into next year, I think it'll open up a little bit.
Well, I think that's very, very good news for this group. An interesting article I pulled from the San Francisco Business Times just a couple of days ago. Of course, we're not San Francisco, and we're thankful for that. But the statistics are pretty interesting. It's entitled "Down Venture Rounds Exceeded Up Rounds in Q1." Down venture rounds exceeded up rounds by 46% for down rounds to 25% for 90 tech and biotech companies in the Bay Area that raised capital in the first quarter, according to Fenwick & West. Some 29% of the rounds were flat. The information comes from Mountain View-based first quarter 2009 Silicon Valley Venture Capital Survey released Thursday. This was the first time since the fourth quarter of 2003 that down rounds exceeded up rounds. This represents a significant decline from the 25% average price increase reported in the previous quarter and the lowest quarterly result since we began reporting the barometer in the first quarter of 2004. So, a lot of people would read that and say, boy, things are awful. I think it's pretty good. We're still funding. So the fact is that all asset valuations are coming down, to your point, Tom, but money is still flowing. I'm just curious, are those new deals or follow-ons or both, the 2 and the 5?
Those would be new investments.
New investments.
Right, yep.
That's great.
So yeah, I think the mindset's starting to change. One of the things that we should probably explore, I think it's going to be touched on later, is what part of the market, though, is vibrant. Mm-hmm. Because I think the early stage startup piece of the market is probably a little more frozen out than, say, the later stage or growth part of the market.
Yep.
And that's a function of the risk tolerance going on right now.
Yeah, it's vibrant but has little access to capital. All right. Let's get to our next question. what strategy, which I think is very relevant for our entrepreneurs in the audience, what strategies are currently being used to secure funding, and how has that changed, and how do you expect it to change moving forward? Are the successful businesses today that are getting funded, are those 2 in the first quarter and the 5 in the second quarter, are they doing something different than they have traditionally done? Are you looking for something different? You alluded to this, Tom, and not just to you, but to anyone here on the panel. What's changing out there?
Just maybe to give you some perspective on the down rounds and why there is so much risk aversion out there is ultimately the venture investors may not feel like they're getting paid for the risk they're taking as they look at a Series A round and move to the Series B round. So I would say probably one of the key things for all of the entrepreneurs out there as they're starting to build businesses is really to focus on the capital efficiency, so that VCs, as they look at the time between a Series A round and a Series B round, feel that there's a long enough gap that they can prove some real critical things out to actually warrant another investor coming in at what they consider a reasonable price relative to the risk that they took, a year or 2 years before that in the Series A round. So I really think the big thing is capital efficiency, doing much more with much less, and I would say that's probably one of the biggest things out there.
Nelson?
We definitely are looking for capital efficient opportunities, both on the software side as well as the hardware side. And I'd say the companies that are very successful at getting most investors' attention are those that get early customer traction. So, and that could be as little as a few $100,000 or a couple $1 million in revenues with very little capital put to work, which typically requires heavy focus on a specific problem for a specific set of customers that can then be extrapolated, so we can understand, okay, we know who the customer is, what's a specific problem, and we understand how that can become a huge opportunity. But getting some customer traction is very helpful, and in many cases, the smart entrepreneurs are using that basically as non-recurring engineering to fund their operations. And so the very scrappy ones are doing that very, very well. So they're not depending on outside investors, they're actually getting customers to help them fund their development, which has been something that gets our attention a lot. It doesn't have to be a lot of money, but any small amount of money from a customer these days is huge in our book.
Great. Any other thoughts on the panel?
The only thing I would add is that we really haven't changed our investment thesis since we started. So it's a very specific growth stage company, and when we find it, and it can be anywhere in the globe, as long as it's in software. But generally, to your point is that I think, one is that it's got the right sales and marketing economics. If you look at the business, you can see that there's some level of repeatability based on historicals, and also that the business is cash efficient. They're trying to grow it in a responsible way, and that there's a good market opportunity. It's got to be a fairly broad market opportunity, but one that you can go out and really get sustained growth. So we would generally look at that. We do look at growth stage. So a company's probably doing $500,000 a quarter, growing pretty well, good gross margin, good low cost distribution. So that's kind of what we look at.
Yep. And CEOs, you can use this time to your advantage as well to drive focus.